Thank you very much. Good morning. สวัสดีค่ะ So first and foremost, I would like to extend my sincere gratitude to the Bank of Thailand for this esteemed invitation, and also for the team for such an amazing organization. Thank you, Kakumanaka. And also, I would like to mention the assist and support from our Foreign, Commonwealth and Development Office for making this introduction. So thank you. My name is Kefirah. I run a boutique consultancy called FinServExpert. We are a small consultancy with only 17 consultants. Actually, I have one of them here. This is my colleague, Nick. Thank you, Nick, for the support. Our clients range from the newly emerged fintechs and the large international, global, and central banks. Last November, we were awarded with the opportunity to be able to working with the Bank of Thailand on a research project. So during that project, we reviewed the literature that was available and as regards the implementation of open banking in other jurisdictions. So I served at that project as a delivery expert, as someone who has global experience of deploying fintech solutions. I had the honor to work alongside with the public policy expert to make sure that their deep insight can actually map into the feasible solution, thus drive achievable and measured results. So during that collaboration, I shared with the team a couple of cases. There are quite a few that actually got their interests. And today, I'm back here to share one of the cases that I shared with them. And hopefully that you guys will find it insightful and interesting as well. So the case that I'm sharing with you guys is about UK-based fintech called Finexos. Finexos aims to drive inclusion by unlock the access for the consumers to fairly price the loan products. I met its founder, Mark Fisher, back in 2019. So Mark and I actually meet each other through the introduction of a mutual connection. Before the meeting, I was told that Mark had an idea brewing and was considering to build a digital product, and he needed someone to validate the technology part. Well, so I went there expecting a technical discussion, but it turned out that we had a full-hour meeting. We only probably spent 5 minutes talking about technical details. The rest was all Mark sharing his personal experience. Then the direction of the conversation went into, we brainstormed the solution and the possible business model that we can build on top of the solution. Well, anyway, that was a quite delightful conversation, although it took a different turn. And if now I see it from the retrospective, that conversation really just become the starting of our collaboration. So then the conversation started from Mark sharing his personal experience. Then we have to wind the clock back to the year of 2014. That was a year that Mark took a hit on his personal financial status. It was quite a struggle, and it took him almost 2 years to get his feet back on. During that 2 years, he met a lot of people in the similar predicaments. In fact, they had a mutual support group, which Mark usually visits. So in that community, there are generalized like 2 kinds of people. And Mark finds talking to them Mark finds that the engagement with these people made him think. So there are 2 kinds of community members. One kind of Mark would refer them as desperados. They were credit gambler. I will explain why. So this group of people are quite financially stressed. However, they had a savvy strategy of gambling their finances. They navigate the credit system so well. So the common conversation they would have would be how to prioritize payments among different credit operators. You would always hear things like, oh, I do not have enough cash this month, so maybe I just make an overdraft from my bank account, and then I can make a minimal payment to my credit card. In that way, I can keep my credit score unimpacted. When I heard that during that conversation, I got astonished, and I got goosebumps literally, because it is scary in one way, because the credit score couldn't pick up this behavior behind, which means the credit score, the accuracy of the credit score is declining. This is a tool that the lenders is going to use to evaluate credit worthiness, but it is no longer accurate. That's my one reason be astonished. The other is that this individual, their situation is desperate. This risky balance could be easily fall apart with the smallest unexpected financial push. So they're actually in a quite vulnerable position, and they are actually the people who need the help most, but they get trapped in this revolving credit trap. So this one type of individual. The second kind of individual, they were reasonably wise. They knew that the high interest credits would give them impact in their life. They are more cautious, so they look for the fairly priced product. But however, they constantly get challenged on finding these suitable products. Because as mentioned, what is happening? Because as I mentioned, the lenders no longer trusting the credit score because the accuracy is declining, right? But however, the lenders had to do the business, so they all developed their own ways. On top of the credit score, they have another kind of evaluation systems, but different lenders would evaluate credit worthiness in a different way. Some of their methods could appear to be a little bit biased, even though they didn't intend to, but the results could somewhat be biased. Well, let me give you an example. So Mark met a woman from that community. Her name is Caroline. So Caroline is the first generation immigration, and she also happened to be a single mom with 2 kids. During then, Caroline was stuck with an expensive mortgage, and she wanted to refinance that mortgage to resolve her liquidity issue. She went to talk to a lot of lenders, but all the loan officers that she spoke to then just told her, sorry, we identify you as a high-risk customer. Caroline was like, why? Could you please tell me why? Then is there anything that I can improve? These officers couldn't give her a specific answer. So actually, Caroline was judged and evaluated by ambiguous criteria that either she couldn't have a control over or understanding of. Well, this is just a microcosm of a broader problem. In that community, Mark saw countless individuals who were either get trapped in this high-interest loan issue or got judged by the opaque system that they had no way to understand. And also all these issues reflect the problem that is plaguing the UK lending market. So then Mark made a determination. He said to himself, I want to make a change. Then a few years later, Mark's situation gotten better, and then met me. We were having that conversation. Eventually, Mark passed his question on me. Mark was like, Kefirah, so do you think if we use open banking data to make loan decision, would the decision be less biased? Well, my first reaction is that this can be a good solution, and according to my experience, that is a feasible solution. But however, I see more than that. I think Mark actually underestimated the solution he was talking about. Because Mark's angle is about removing bias, helping the consumers. But if you look at that from the lender's perspective, the individuals like Caroline, they are financially responsible. They actually can be the high-quality customer for the lenders. So Mark's solution could actually unlock an entirely new market for the lenders. give them more high quality customers without compromising their risk control. So I think the solution actually benefits the lenders more. So I told Mark the perspective. Well, Mark agreed with me and liked the perception that I added onto the equation. Then he went on asking me if I know anything about or have any experience about implementing the PSD2 compliant data exchange protocol. Well, in fact, I do, because just as Mark and I spoke, I was on a project in Hong Kong. I was then got assigned to Hong Kong, leading the delivery of a WeLab virtual bank. And 2019 was the year that Hong Kong's fintech innovation emergence. With the introduction of its open API framework initiation, almost all the banking solution, as long as it gets payment involved, that part will be the part that would be taken into consideration. So I said, yes, Mark, I do. However, I don't think this data exchange protocol is something that we should consider as a priority. My opinion was based on two reasons. One is that because this data exchange protocol is actually a byproduct of the open banking framework. So it is very focused on the bank account data. But however, Mark's solution can be enabled by a lot of data. It can be enabled by heterogeneous data source. So it does have not to bound to open banking data. So if we consider that data exchange protocol, first and foremost, that actually puts some constraint around, and that affects the solution's scalability, if that makes sense. So that was my first reason, and I explained to Mark. I said, Mark, using a transaction data to make a loan decision, this is a proven concept. This existed even before the open banking concept became a trendy thing. I will give you guys some example as well, because back then I was working in Hong Kong. The transaction data does not have to bound into a bank account data, as long as the data has the in and out cash flow and can reflect the patterns of behavior or the patterns of trading. That data source can suffice. So we will see a lot of in SME lending sector, right? Those small businesses, they usually do not have enough financial data, and their credit profile isn't that sufficient. I saw a lot of innovative solutions that just use the trading data from the SME's accounting book or their e-commerce ordering system record to make a decision. And based on that decision, they will know whether or not that business is reliable for repaying the loan. So that's an example. And since Mark and I were talking about consumer loan, so I gave Mark another example, which can be more convincing, and I want to share with you guys today. I deliberately picked that example. It is because it happened in 2014, and it happened in Kenya. 2014 was 9 years ago. During then, there was no open banking concept, right? And I want to mention Kenya. Kenya is a developing economy. Their infrastructure is way behind than what you guys have in Thailand now. So the solution is called M-Shwari. M-Shwari is a micro-lending product running on top of a mobile banking platform called M-Pesa. So in a country where half of the population didn't have proper access to traditional bank services, M-Pesa allows the individuals to make the day-to-day payment and transfer using their mobile phone balance. So using their SIM card, you can consider that their SIM card is their mobile wallet. If I pay you money, I could just basically text you. That's how it worked. So after a while of up and running, M-Pesa have a lot of SIM card transaction flow. And M-Shwari, the solution we were talking about, was able to make a use of that SIM card transaction flow to build an algorithm on top of it and use that to determine someone's lines of credit. Yet the intention was to use that as an alternative to FICO score because half of the population was unbanked. But however, that solution delivered I remember it was like 26% of the reduction of the non-performing loan for the underwriting bank. So it's actually outperformed FICO score by 26%. So from that example, I just want to say that, when we talk about this solution, the mindset, we don't have to be bound to the bank account data. There are a lot of data sources available. As long as it's cash flow based and it can reflect the patterns of behavior, those are the data that you can leverage. Those are the things that I shared with Mark the other day, and I hopefully this is something that can inspire you guys in your daily practice when you design your own solution. So that was my first reason. My second reason is ruthlessly practical, because my second reason why the data exchange protocol stuff does not come as a priority is because we, as a startup, Mark have a very stretched budget, right? This is something that I would rather recommend him to collaborate rather than reinventing the wheel to build it something new on his own. Because during then, the open banking ecosystem in the UK is relatively established. There are already some fintechs around and joining the game. So I bet there are some partners. They've already have that capability done. So why reinventing the wheel? Instead of compete and build your own things and waste your resource on these common capabilities, just collaborate with one. This will be a win-win. So this suggestion was based on my learning of delivering fintech solutions with other businesses. Some of them were successful cases in this ecosystem. So I learned from them. Based on my observation, I think what makes them successful are two things. One is that they are really, really mindful on how they use their budgets. So instead of building something that everyone else has, they focus using their budget on the things that really differentiate themselves. So in Mark's case, that is the algorithm. That is not the data exchange protocol. That is not KYC. That is not customer onboarding journey. We don't even have to build a UI first. Just get the algorithm up and running because that is your differentiator, right? So the other thing that I learned from the successful cases is that they really attached a great importance on their architecture. So instead of spending money on data exchange protocol, spend that money to harness your architecture because it is very, very important to have a modern open architecture. This architecture will make it easier for you to expose your own capability and have your own capability as an element embedded into other people's solution that facilitates the collaborate. And the other way around is that it also makes it easier for you to leverage the third-party capability, right? So that is the mindset. So this kind of collaborative mindset reflected in the architecting design and the digital solution design. Those are the successful cases that I've seen and I shared with Mark. So, Mark obviously found the conversation was useful and 1 hour went by very fast. Approaching to the end of the conversation, Mark said, well, I saw the news. The virtual bank that you were delivering is launching before the Christmas. Do you have any concrete next steps? In fact, that was a timely question because, in fact, honestly, I didn't. And also, but when it comes to preference, I always knew that what I want to do. After the conversation, I realized that what Mark is trying to do could, if succeed, could actually bring some difference into the lending market and can bring the direct impact to human lives. That's something that I've always wanted to be part of. So then I said, well, it sounds like you have an offer. Then 6 months after that conversation, I worked with Mark, and we worked together. I worked as his CTO. Then we started the whole Finexos journey. Then the time fast forwarded to the year of 2021, Fiola was born. So Fiola is the AI model that we built to predict the loan performance. Now I'm going to introduce the solution. So Mark and I both believe that to predict loan performance, two aspects have to be considered and have to be considered separately: human behavior and product suitability. Let's talk about human behavior first. So we reckon that regardless how great the financial situation for the time being is, it does not always guarantee that the individual in that situation could effectively manage any unforeseen financial challenges. Because financial situation is something that out of complete control of us, but behavior is. So instead of put a lot of effort to evaluate the stability of financial situation or to try to focus what is going to happen, we put more focus on understanding the patterns of behaviors. And we believe that these patterns of behavior will help us to predict how these individuals are likely to behave in future possible scenarios. Well, let me give you an example. So there's a young lady that we based our initial study on. Her name is Kefirah. Kefirah is a social media influencer. So what she does, making a living, is post YouTube channels and Instagrams. This is a kind of occupation that a lot of elder generation wouldn't consider as a proper job. But anyway, when we studied Kefirah's transaction history, we found that there could be 2 months that she doesn't have any significant income. But on the other hand, there could be situation where within 1 month, she receives multiple payments. But what stood out in our model was not how unpredictable her earnings are, but her capability of adapt her spending pattern into that unpredictability. Let me tell you, so when we visualized her spending pattern on the burn-down charts, right, the duration of the timeline, they vary largely because her earning pattern is so unpredictable. However, the gradients of decline of the cash burn rates remains largely unchanged. So in other words, she made sure that she never ran out of cash. So this is an example that in all these unpredictable financial situations, how predictable the human behaviors are. Right, so this consistent expenditure burn rate is one of the factors that we had in our model. In conjunction with the other 240, Fiola system is able to portray a comprehensive behavior profile of that individual. We then translate that profile into a score. Then we call it financial capability score. But this score by itself now cannot predict the loan performance. Why? Because we've only talked about the first aspect, right? So there's another aspect, which is product suitability. So regardless how effective an individual could manage her cash, if she didn't choose a proper loan product, say if the interest is way too high for her to manage, she could still default. So concurrently, the model would take into consideration the long term and the loan interest rate to make sure that the product price is set perfectly for the individual's financial standings. Then after evaluating from both dimensions, Viola will output a combined rating. It is this combined rating that we use to predict loan performance. Yeah, this is just at a high level how our algorithm is get designed. Now let me show you at a high level how the model is getting configured and how it's get used into the day-to-day lending practice. So as you guys can, I will probably stand here so you can see it better. So as you can see that on the screen, this is at a high level how the model get configured. The model supports to run in one of the two modes, and it's up to our lending partner to choose, right? So mode 1 is to help the lending partners to understand the probability of default of a specific loan application. And mode 2 is to help the lending partner to understand the maximum affordability of a borrower prospect. So to run either mode, the lender will have to input the loan term and the loan interest rate to start. To get the probability of default, they will then input the total principal balance of the loan. Then they will get a percentage, the likelihood of default rate. And to get the maximum affordability, the lenders will have to first estimate and determine what is the highest default rate that I am willing to tolerate. Then after making that consideration and decided fitting that percentage, and then the machine will return the maximum affordability of the individual. So this model by itself is quite straightforward, and the intention behind is that we want to make the onboarding of the operational staff very easily. So the configuration has to be designed quite straightforward and intuitive. But however, this simple configuration that we put on the table, it took months for our lending partners to figure it out. In fact, during our live trials, usually we just sat with our lending partners for months to figure it out. Do you know why? Because usually, not long after, the lending partners, they just spontaneously realize that when the capability score fall into a healthy range, offering a lower interest rate can actually reduce the average rate of defaulting. This is a pure mathematic issue. Can you tell from that? So this is actually, we want to use this model to show, to reflect the linkage between the human behavior and the product pricing. Thus that we can facilitate the thoughts, okay, then how do I best strike the balance between the risk that I want to manage and the profitability that I want to achieve? So by showing this linkage, we want to get our message across. You need to make your loan products more affordable, thus drive the ethical lending practice. So we've conducted several trials in the UK, and we received great results. So we are making progress. But while everyone else is celebrating our progress, Mark put another challenge at my table. One day when we were at a client set, Mark just woke up on me and saying that, Kefirah, I'm still not convinced that we are helping everyone. And I was like, what did you mean by we're not helping everyone? Mark said, you know, the model now is helping the ones whose capability score fall into the healthy range, right? But what about the individuals whose score is not healthy enough? We didn't help them, but are we in any position in helping them? Well, that was a challenging one, and I didn't right away have an answer for Mark. But there was a silver lining. As mentioned, financial situation might be something that out of the individual's control, but the behavior is something that one can improve, right? Given there is enough awareness and motivation. Meantime, one of our lending partner proposed an idea. The lending partner just woke up to me and said that, what if we provide that motivation? Then both Mark and I was like, what did you mean by provide that motivation? The lending partner was like, okay, so as lenders, right, we usually take risk. We lend to the individuals whose financial profile looks less convincing to us. And to make up for that risk, we lend to them with high interest rate. What if that we collaboratively, we pick a group of individuals whose capability score looks promising, but not quite there? Then we can start lending to them with a slightly higher interest, right? And then we tell them, work on your financial behavior. The improvement of your financial capability score will trigger the reduction of your loan interest. Well, I think that is a smart idea. And then the lender went on. He said, look, this individual, they will play with their credit score anyway. So instead of having them manipulating their credit score, we invite them over and we encourage them to game with their capability score. The harder they work at it, the more they are aligned with the expected behavior that we want to see. That is anyways a win-win. Are you up for it? Well, hell yes, we up for it. And that's a brilliant idea. But for one, it resolved the issue that Mark put at my desk and I didn't have an answer for. Now I have. And also, it means that our lending partner is fully onboarded with this ethical lending philosophy and trusts the new method fully enough to build a new business model on top of it. So to me, that was huge. So to bring life this business model, in my opinion, 3 things are essential. The technology capability, and balance sheet provider who are on board with this lending philosophy. Last but not least, the open banking ecosystem. Earlier, we briefly chatted about how this open system being collaborative and being open. And now I would like to spend a little bit time to talk about how it is customer-centric and how it's helped to improve the overall financial experience for our customer. So, nowadays, we operate in markets where the data ownership awareness is rapidly growing. So whenever our customer grant us access to their data, they demand a clear purpose. And more than often, they expect a concrete value in return instantly, right? Because our customers are become smarter and smarter. As businesses whose business model depends on this kind of data access, it is very important for us to design a smart customer interaction that builds trust, gain access, and reciprocates with tangible benefits instantly so that we justify that trust and we sustain that trust. This kind of interaction was relatively complicated to design if there was no open banking infrastructure. But with this infrastructure, it's made our job easy to design such interaction in the UK market. So here, I'm giving you a high-level example about how Finexos designed its interaction. Finexos will ask data access in 3 scenarios. So we designed 3 types of interaction. The first interaction happens, the initial interaction happens during the loan application process. During that process, whoever comes to the website and asks for a loan, we will ask them to give Viola access to their current account transaction data. And we made it very clear that this is a one-off access. And if the customer relationship does not continue, all their data will be deleted 30 days after the permission was granted. That was according to the data protection law. So we made that very clear. And as an instant benefit in return, everyone who gets applied for that loan will get a comprehensive financial healthy reports to interpret their behavior profile for them. That is an in-detailed explanation of their financial capability score. So regardless, at the end of the day, they get the loan or not, whoever participant in this interaction will get that report. And another thing that I would like to mention is that during this stage, all the applicants remains anonymous to us. This is a deliberate choice, and this is also a byproduct of the infrastructure's interoperability. Say it is a deliberate choice, it is because Fiola actually doesn't need personal identifying information to make loan decisions, because we are behavior driven, and we don't think that the difference in occupation or the difference in nationality would impact how you behave. So everyone to us is universally the same. They are just in each individual behavior profiles to us. So to best eliminate bias, our APIs just do not accept those data that could tend to be biased, and we don't accept PII data. Every application remains anonymous to us until after we find a suitable loan product for them. And if our lending partner agrees with our recommendation, they would elect that anonymous application as a loan prospect and conduct their KYC process outside of Fiola system. So yeah, that's why this is a deliberate choice. But on the other hand, this is also a cool functionality that's blessed by this tech infrastructure. So let me show you here. In this equation, I actually made a still high-level illustration to explain this. In this equation, the customer, the data owner, is the ones that get the service. And the whole infrastructure and the whole elements down below are the ones that collaboratively provide the service to them. So then the service providers are actually four parties. We have Finexos as the data consumer, who use the data to run the algorithm and output the decisions. And then we have the banks, who act as the data custodians that release the customer's data for Finexos. And here, down below, there is a very special part. It is another tech solution. It's commercial data aggregator solutions. So what this solution do is that they harvest the data from the data custodians on Finexos' behalf of, and then output the data in a structured and aggregated manner to Finexos, so that actually makes Finexos querying easy. We choose to not interact with the bank easily for the same reason. Why do we reinventing the wheel twice, right? We choose to collaborate with the aggregator because that would be anyways the win-win, and that's actually a better experience for the customer. So, and in this equation, when customer grants the data access through this infrastructure, their data consent will do two things. First, the consent will allow the aggregator to access to their various bank accounts to harvest the data. Meanwhile, allows Finexos to use the aggregated data from the data aggregator. And since the bank and the data aggregator has already done the identity authentication, it ensures the data's authenticity and confirming the data is belong to that relative individual. So there's no need for Finexos to validate that identity again. I hope that serves another example as how collaborative mindset and how the interoperability plays a role in this whole equation. Well, so yeah, that is the first interaction. The second interaction here targets the individual whose capability score looks promising but not quite there. yeah, we chatted about this individual before, right? So when our lending partners decide to extend a loan offer to this group of individual, in the terms and condition of the loan offer, it will says that, okay, if you accept this loan, you will give Fiola Engine persistent access to your current account data throughout the entire loan duration. So throughout that time, Fiola is going to access to their current accounts and to query the data. Financial capability score will be recalculated in a monthly basis that serve as a consistent metric for the lender's ongoing monitoring. And as a benefit in return, this individual is possibly to get a reduced loan interest if their capability score improved. And here I want to replace the if to when, because according to our live trial, the initial candidates that we picked up for targeting this trial, 100%, all their capability score improved. And that is also a proof that we find the right motivation. Okay, then move on to the third interaction. The third interaction targets to the individual who are not yet qualified for a loan. So in this case, we will guide them to the repel programs. So there are a lot of good quality repel program, public ones. They were for free at the UK market already. They are targeted on financial education and literacy. And I know that some of our lending partners are developing their own repel programs as well. But the intention is that Fiola tries to serve as a platform to provide the behavior profile to these programs, so these programs can design the target solutions for the individuals who are in need of help. So if the individual agrees to get opted in one of these programs, one of the conditions they would have to tick is to give Fiola ad hoc access to their current account transaction. Because this access will help the program that's joining in to have a more comprehensive understanding of this individual's situation, so that provide a tailored suggestion in terms of how to improve. Well, as a benefit in return, this individual will get a customized service and a tailored suggestion. Also, Fiola is going to give them timely notification when there are loan products available that's suitable for their improved standings. Well, so that's the three interactions that we designed, and this infrastructure really helped our design, because every time we request for data, we were able to make our communication very clearly, and we can provide the constant tangible benefit in return. And also, it facilitated the multi-threaded communication among all the elements in this equation, thus provides the best financial service experience for the customer. Well, so that is the context of why the solution came into being, how we designed the algorithm, and how we embedded ourselves into the ecosystem. While that brings to the end of my story, I would, before I give back the floor, I would like to ask, do you have any questions? Or do you have any stories on your industry that you would like to share? Then we can discuss. Questions? Any? No, I guess. Okay, then. Okay, no. Right, I think that, okay, that would be the end of my sharing. Thank you very much. ขอบคุณมากนะคะ